This is Chuck Oliver. Welcome to this week's Taxes Saved Case of the Week. Now, this week we've got a business owner that we're going to demonstrate using a very unique strategy that has reduced his income tax greatly, and then being able to reinvest the otherwise spendable taxes has a lifetime opportunity for earlier retirement as a result of redirecting unnecessary taxes. So, Davis, let's jump right into this case.
Yeah, another exciting one here this week, Dad. So we'll pull this up, share my screen here. And so, yeah, like you said, this is a high income business owner, and we'll break down their scenario here. So you get a view. They're a single filer as well, in the state of North Carolina, right? So here you'll see on the left, we got the tax return for this client, and we'll go through a few pages on this today to really break it down for those that are watching. But here we're going to look at a few things, right? Because we implemented strategy, it opened up another gate for us to be able to save additional taxes with things called QBI, qualified business income deductions, right? So let's break down this strategy, right? And what this client did. We'll break down their profile first. So here you'll see we have some W-2 income, right? So they have a W-2 salary, but they also have their own business, right? So it's a unique scenario for this client's example. So here you'll see on line 1Z their income, right? Of what they had from W-2. And then we have to go down here in the tax return because you'll see there's from this business income, right, where the deduction was taken, right? So we'll go ahead and down here. And so here you'll see, right, some of the partnership here. This client is an S Corp, right? So they have an S Corp design for their business, right? So you'll see their income from their S Corp was right here, $466,000, right? Right here. Now let me highlight, but you see it there from the K1 this client had. And so what this client did, right, right now they're facing all of their income added up from what you see here, from the W-2 plus this income right here of the 466, gets on the right here this annual income of $578,000. And they're a single filer, so those brackets are worse, right? So they're facing a federal and state tax of $193,000 doing no strategy right now. They're in that 33.4% effective tax rate. So what do? Right here, you'll see they invested in a movie. This one was called Alarum, right? And so that generated a loss. Here, they invested $50,000, right? And to learn more about this strategy, this is Section 181. We talk about this in last week's case study in a different example. But here you'll see, right, they have this about $215,000 loss, right? And so they take that against the other business income they have from a partnership, and they're going to minus that 466 minus that 214 to where now the reportable business income is $252,000, right? So knowing that, we'll go back up here and we'll see here now this on line 8, this $252,000 of reportable income, right? So all of that income added up, the 111 of W-2 plus the 252 of business income, we're at $363,000 of income. But now, because of their new lower income from the movie deduction, we now get to use things like some of their itemized deductions as well as QBI, right? Qualified business income deduction, because the movie deduction lowered their income, right? So now, after this film investment of $50,000 to generate a $214,000 loss, what did it do for them, right? So the impact analysis. Here, they took the taxable income from $578,000, owing $193,000 of income taxes on that, state and federal, to after that deduction, they lowered it to $320,000, and now their new tax burden is $91,000. They went from an effective rate of 33.4% to 15.8%. So what was the tax savings ROI, right? Here in the first year, this client was able for $50,000 save $101,670. It was a 203% ROI, and there's a 17.6% rate reduction of effective tax rate for this client in their example. So you can see here, Dad, this was a real exciting one. With just using really, the effectiveness of a minimum of a strategy to get the biggest bang per buck of lowering that effective high 30% tax rate down to those the teens of tax rate.
Yeah, if you think about it, Davis, slide over to that QBI. I don't know if some of our business owners, and by the way, we teach people we call it QBID, QBI, or QBID, qualified business income deduction. Then slide back over And you figure, the gross return, effective rate was about 34%, we'll call it, on $43,000, right? That's another savings of $14,000. So I want to make sure people don't miss this. For those of you that aren't business owners, here's what's great. We can teach you how to have a business and create these similar deductions for you. And whether you're a business owner or not, the deduction we used in this example, right, with this client is actually one that you could use as a high W-2 income earner or a high self-employed business owner. But don't miss this. There's certain phase outs of deductions like qualified business income deduction that unless you can get your income down to a certain level and the thresholds are inflation adjusted, you wouldn't be able to get that other $43,000 deduction in play, which would have resulted in you likely overpaying another almost $15,000 of unnecessary taxes. That's why I say it comes down to timing and technique. And if you don't have a proactive wealth and tax team, just as a client shared with us the other week, this, you know what I like and what I love about working with you guys is that you have synchronized the importance of both sides, right? The wealth side and the tax side so that nothing gets missed. So if you've not been there, folks, go there now, taxessave.com. And as you scroll down, there's going to be a little area in the upper right-hand corner under the case of the week. And if you'll click that, it'll post all the prior episodes. And we try to keep the episodes very short, sweet, and succinct so that you can learn different strategies like your friends and neighbors are applying all around this country to get rid of the unnecessary taxes. Imagine removing taxes. And what you didn't see in this particular business owner's case is freeing up that almost $200,000, right? That was reduced of taxable income, saving, right? The hundred and some $1,000s of taxes. What does that look like by putting it somewhere where the government doesn't get to take a bite out of the apple a second time and putting it somewhere where it stays tax free so that that business owner now were able to move up his retirement time frame by about a decade? Go to taxessaved.com. That's taxessaved.com.